Hi, welcome to this live webinar where today we're going to start with coffee. So it's always coffee first. What we're covering in today's webinar is we're looking back at the UK fiscal statement, and it's all in the press, all over, news, excitement for the UK. But what does it mean to expats? What does it mean to UK expats living and working abroad? What does it mean to expats living and working in the UK? And how does it alter the plan for the future about how expats living and working abroad can work in a different way uh, in the future? What we've got is Britannia Unchained in a way. Britannia Unchained in that a growth strategy has been introduced, which is a radical change in the UK fiscal and economic policies of the government for the last few years. There's been this pioneering path towards Brexit, but since Brexit, COVID has affected the whole world, and it's affected the UK, and the impact on that has meant that there's been lots of financial support that's gone into the economy, but that's gone in to maintain the status quo, to maintain people not working, not producing, not generating wealth. Now, that money's come from somewhere, and we are where we are today. The way forward that was previously described has been scrapped, and it's been scrapped in favour of a growth plan where it's looking forward to supply side solutions to get the growth. And yes, it's going to increase debt for the economy, but that can only be paid for by growth. So what are the opportunities and the benefits that expats can seize on? So we've had the initial financial statement, but there's actually much, much more to come. This is a radical change of strategy, and it is probably, we will look back in hindsight and see that the budget of November, the budget of September 22 is the first truly post-Brexit budget for the UK government, and a chance for them to move forward under a non-EU basis in the new world that's ahead, which obviously is quite radically different from 2016, post-COVID, post the European conflicts, but the opportunities still exist for the world. Some of the changes that after the financial statement in September, there's going to be further announcements rolled out in October and November. And these are going to culminate on the 23rd of November in a medium-term growth plan for the UK. So we'll see more of a clear fiscal statement then. But in the meanwhile, we're going to look at and see potentially changes to business regulations and immigration, in addition to the tax changes that we've already seen. So we'll look later in this webinar at the tax changes that are going to be implemented that can benefit expats working through the UK. So what about the other side, the business regulations and immigration? Now, those announcements are still to come, but to get any non-UK citizen into the UK, unless there's some sort of special working requirement and working visa, they need a salary in the region of £25,000 or more to get a working visa in the UK. Now, that is absolutely fantastic, and that's what people in the UK want. That they don't want cheap jobs, cheap labour. They don't want people undercutting the salaries. If we want the salaries to increase and the payroll to increase in the UK, then we've got to have a well-paid workforce, and business has to be motivated to generate the revenue to pay those higher salaries, or for the business owners, need to be assuming that they want ownership, and that's the aim of their business, of their contracting business, that they're aiming for ownership to make profit. And if profit is the game, then they've got to have the incentive to get there and the regulatory environment to get there down the road without paying all the monies in tax. So the tax incentives are very much the first step. Some further regulatory and structural changes will be announced in October and November, and we need to look out for those to see what the opportunities are for expats living and working abroad. Ownership is the aim of an expat contractor. Profit is the game, and we can do that with the tax cuts that we've seen. The tax cuts in this budget are the second biggest ever in a UK financial statement, and they'll need 1.5% of the government. So not the government, the gross domestic product, the total production of the UK, to pay for the tax cuts that they've introduced. And this is why we see all the fluctuation in the market. It's not all the doom and gloom. It's the markets adjusting to change. This is a radical change of budget. It's a radical change of strategy. And it's a growth strategy. So while they've done the tax cuts now, that doesn't mean that there's going to be more long-term borrowing and more debt from the government point of view. What the government are investing in is to say that they want business to invest in the UK. They want business to retain more of their profits and their income, to make profits, to create more wealth and more jobs and grow the British economy. So the British economy grows by 3%. The tax cuts will not increase borrowing. Borrowing will in fact fall, and lo and behold, the pound will get stronger. But that's what markets do. They react to circumstances as we go along. So it's a completely different approach. It's an approach to unchained Britannia post-Brexit. For those of you that do know, you'll know that about 8 or 9 years ago, a book was released called Britannia Unchained. Now, it's written by a number of notable figures. I mean, two of those are Liz Truss and Kwasi Kwarteng, the UK Chancellor. There are some other famous political names put their name to it as well, Dominic Raab and Priti Patel, who were in Boris Johnson's government, and they're not in the current arrangement. But essentially, that was the transcript for a post-Brexit Britain, a Britain that can be a tiger economy in Europe, that can have the regulatory freedom to allow expats to do business across border without high penalties of tax. It works in Hong Kong, it works in Singapore, it works in to a greater or lesser degree in other countries like Cyprus and Malta. Britain has now got the lowest corporation tax rate in the G20 economies of the world. And that's where it might want to position itself long term. But it could be that they want to actually position themselves to be even more competitive, to compete with the Hong Kong and the Singapores of this world in a different time zone. So we will see. So looking at the financial statement and looking at the September budget from the UK, let's consider some of the tax cuts that they've made and the opportunities are open to expats. So larger expat business investing into the UK, there are now investment zones. So business within the UK and without the UK will be able to look out for a business zone opportunity and get zero business rates and some other capital allowances. And also save employers' national insurance. So employers' national insurance is a tax on jobs. The employer pays it for every £100 they pay. That they're paying the additional percentage of that salary to the government. So it's a tax on jobs. So it's a freedom there. So if a business that wants to go international wants a lower cost base, then the investment zones will offer those opportunities in a technology-free world where we can connect with people around the globe. Why can't we have administrative and call centres set up in these locations to service clients around the world? And those opportunities will exist for British companies as well as others. So there's big opportunities ahead that are available that we need to consider going forward. So for more information, guidance on that, you can contact us at projektpartnership.com. The other tax that will have an impact for expats is if for expats that want to invest in property. Property taxes have gone up massively in the UK in the last few years, and this is the first sign of that property tax increase regime being reneged on and relented a bit. We've still got the property price inflation. Average property prices vary throughout the UK, but you're talking about 2, 3, 400,000 being an average property price region by region. Two-bedroom apartment in central London will be quoted to you at £1 million. So there's a lot of variation, a lot of change, and it's about getting that foothold. A doubling of the threshold before people pay stamp duty. Stamp duty is a tax to buy the property. So if you're buying a property for about £450,000, even after these cuts, you need an extra £30,000 in stamp duty. So it's either an extra 30,000 mortgage or it's an extra 30,000 off your capital to purchase into the property. So it's a regressive thing in that respect. It's not an exit tax when you sell the property, but the exit taxes are there as well for property investors between 18 and 28%. So those don't change, but the purchase price can go in. Now, again, you have to be careful in the UK because if you're a first-time buyer, stamp duty is lower, the allowances are higher. If it's a first property, they're a bit higher, but they're more flexible. But if you're buying as a property investor or multiple properties, then your stamp duty rates will go up. So you could pay 0 or you could pay 16%. So it's something to bear in mind. But the threshold on which it's paid has gone right down. So getting into the market below 250,000 for expat investors now becomes more of a realistic proposition. So one of the interesting things for me, and we'll see more when the medium-term strategy comes out, is that income tax has been reduced to 19%. Now that was already in the pipeline. It's been brought forward a whole year. So from April next year, the UK basic rate of tax, income tax, is 19%, down from 20%. So it's a small increase, but interestingly enough, for expat contractors, people working from the UK or people working in the UK that might be considering corporation tax v income tax, the income tax rate and the corporation tax rate are now the same. Corporation tax rate was due to increase to 25%. That has now been scrapped as well. So we've got corporation tax and income tax at 19%, which is exactly the same. So if we want to encourage a growth economy, an entrepreneurial economy, where ownership of business is the aim, profit is the game, there's no tax preference to operating as an employee as opposed to an employer, up to £50,000. Because beyond £50,000, there's high rate tax on incomes. The good news for those on the high rate tax at over 145,000 has been reduced from 45% down to 40. So there's only a high rate tax now. So up to 50 is 20%, over 50 is 40%, and that is it. There's no additional high rate taxes. So it's a more lower tax environment. Lots of people will criticize that, and there's an argument for that. But then again, there's also an incentive, because if you do build up from your back bedroom in a small Welsh mining village, or from a Manchester suburb, and you build your business up and you earn that income, that 200,000 a year, then you get to keep a bigger share of your rewards. But are you paying less tax? I've got another perspective on that to come later on. So employees, high earning employees in the UK will pay a bit less tax, but more importantly, as a long-term strategy, is the alignment of the basic rate tax and corporation tax. Now, if you're earning 100,000 on a company in the UK, you've got a flat rate corporation tax of 19%. If you're an employee, you've got an income tax of 20%, of 19%, up to that 50,000. So working through a personal service company could be better for somebody that's earning between 50 and 100,000, rather than being an employee. So if you're an expat and you're working across border from the UK, using a personal service company, then your salary from 50 to 100, you're going to be saving tax, and obviously to 200 and 300 as well. If you're a UK taxpayer, you still get your personal allowance. If you're a tax resident in another jurisdiction, you still get your personal allowance. So even though corporation tax and personal tax are the same, and with income tax you've got higher rates, you can still use the corporation tax, flat rate corporation tax, and get the personal allowance by having a contract which allows you some income and lets a profit declare the corporation tax and then pay dividends at a lower rate of tax. So for more information on personal service companies and how they work for expats to minimize the tax rate, contact us at productpartnership.com. And don't forget, while we're listening, to subscribe to the YouTube channel and watch us again. So moving that theory on and look at the employment taxes, there's national insurances due in the UK. That was due to go up by 2.5%. Some of that's already been implemented from July. That's being reversed as early as November. So that's a very, very quick change. I'm quite surprised with how quick they're implementing that. And God bless the people at the HMRC who've had to implement it and then unimplement that rate for now. But it's quite a quick change around to the rate. But they can do the adjustments with the employers and the payroll taxes before the end of the tax year. So everything will work out for them in that way. So that's probably why it's quite quick. But also, there isn't an additional tax increase coming in April. So that's 2.5% less tax on every pound that you earn. So that is a real tax saving for people. So it's not just the 1% off the income tax, it's 2.5% off national insurance that comes as well. And everyone benefits from that in proportion to their income. So again, if you're an expat based in the UK with a contract in the UK, your national insurance part of your tax liability is now more cost effective than it was before. dividend tax is a way in the UK for a personal service contractor to pay income. So you can now still have your personal allowance, still have an income up to 50,000 at the basic national insurance levels, and pay 19% income tax, which will be the same as 90% corporation tax. So that's all good news. Now, the dividend, if you pay the balance by dividends, your company's still only going to pay 19% corporation tax. So there's no, so that working through a personal service company will actually be more beneficial with a turnover more than 50,000 than working as an employee. So that's something to think about. The dividend tax above that for basic rate taxpayers was 7.5%, and then it jumps up for higher rate taxpayers. That increase that was proposed at 1.25%, that's not now going to go ahead. So it's going to be the same 7.5 or 32% for high rate taxpayers. But again, if an expat is receiving a dividend from a UK company, dividends are movable with you. So if the expat is living and working abroad, then that dividend tax is not withheld in the UK. So dividend tax paid by a personal service company in the UK is not a withholding tax. It's not a tax that's paid at source. It's a tax paid by the recipient of the dividend in the country where they are tax resident. So when you get a jurisdiction like Cyprus, for example, if you're a tax resident there, as a non-dom expat, the dividend tax rate is 0%. And then in other jurisdictions, there are 0% tax on unremitted or overseas earnings. So you can be living and working in Portugal, and the dividends that you're paid are paid from an overseas personal service company or management company, are not going to be taxed in Portugal. So under the non-resident tax scheme in Portugal, you're only paying tax on income that's earned in Portugal or from not so much from abroad. So there's some big opportunities there, and there's some other jurisdictions in Europe and around the world that you can use for that. We've said many times that you have to have a tax residence somewhere, but it doesn't mean that you have to pay tax. So for more information and guidance on that, contact us at productpartnership.com. Comment here below if you've got any questions. We'll try and answer them in our blog. And you can message us as well. We've got a live chat forum which we can help you with. ProAct's retained client service offers online consultation and advice to clients. You can go online, you can book a consultation with a consultant and get real answers in real time to your questions. And if we need to do a deeper dive, we can help you and assist you with that as well. Book your consultant's review for your tax issues at productpartnership.co.uk. So the greatest thing, the very best thing, the biggest pain in any contractor's life in the last few years in the UK, and the biggest regressive tax on entrepreneurial and business growth has been the extension and the creeping extension of IR35 rules. And the big change that came in the last couple of years was that IR35 rules, the responsibility for making that decision was transferred to the contracting company. So if you're a big international contractor or just any UK contractor, then it's your responsibility for the tax you're paying to the contractor. So UK traders, UK personal UK small entrepreneurs, people aiming to create a business, and in the game to make a profit as an individual, and have this entrepreneurial zeal to create a small company to grow to a bigger company and a bigger one. With IL35, that has wrecked that all. Now, there are reasons to come to that, but there's always consequences as well. So large contracting businesses turning over 150, 200, 3, 4, 500,000, maybe a million, maybe 2 million, suddenly become severely impacted and negatively impacted because the contractors of those companies are brought under the scope of IL35. And effectively, IL35 rules means that the contracting company is liable. I just put my hand on the microphone. Sorry about that. The contracting company is liable for the tax that the contractor should pay. So if an expat is trying to contract with a UK company, the risk is with the UK company if the contractor doesn't pay the right amount of tax. And so it's for them to decide within the rules whether it was a payroll situation or a true contract, entrepreneurial business to business contract. And so many people that have been trying to work independently with their own personal service company found themselves brought under pay-as-you-earn rules with the respective increase in tax, which has mean for the UK, it's lost many mobile expat workers, and UK people have gone expat. So that IR35 rule is now being reversed from next April. So the personal service company will now be allowed the freedom to contract with other firms. And, the personal service company could be, a significant business. It could have a team of 6 people providing a service to a bigger company. But now those people won't be brought under payroll restrictions of IR35, which increases the cost to the contracting company of national insurance for the employer and the employee and the extra payroll responsibilities. It enables them to leave that responsibility with the contractor to be liable and responsible to manage their tax and their affairs correctly. So this is a great opportunity for the personal service company with a UK company with the lowest corporation tax rate in the G20, and now a lower income tax rate and other benefits, reductions in national insurance and other taxes, along with the investment zones, to really reignite that small entrepreneurial business where people that want to build up their own business, who people want to build the ownership of their small business, where profit is their game from that small business and paying a fair amount and the right amount of tax, release that entrepreneurial growth to grow the economy to pay for the tax cuts. That's the plan. For more information and guidance on working as an expat with a personal service company and the changes to the tax regime, obviously there's contact us at productpartnership.com or subscribe for a consultation at productpartnership.co.uk. Have in mind that these changes are coming in now. We now know that they're coming in from April next year. So we're talking about next tax year. We've got the current tax year as well. So don't forget that if you're in a situation where you've got a potential conflict or an IR35 situation or a higher tax situation with your expat business, there's maybe some short-term measures that you can take, some tax planning tools you can adopt to defer income and hence the liability to tax under the higher tax regime that's going to exist until April this year. So you can only work with what you've got, but then in the final 6 months of the UK tax year, there's some tax planning opportunities there to defer income or expense liabilities into the next tax year and save a bit more tax and pay at a lower rate going forward. So in summary, for expats, the budget statement of September 22, for expats, in summary, the budget statement of September 22 means that there is a release of pent-up managed arrangements. The budget of September 22 means that the UK has radically reset its fiscal and monetary and economic policies to one of growth. And there's going to be a number of structural and regulatory changes that are going to be announced through October and November 2022 to accelerate the process. What we've seen in September is significant reductions in taxes and opening up of investment zones so that inward investment into the UK, as well as contracting entrepreneurial small business in the UK through the personal service company, is now able to thrive and flourish from the UK. And we, in a low tax competitive environment, there is a potential that the release will be progressive and that the next budgets will reduce even more reductions in taxes in future years. Britannia is unchained, the post-Brexit world of a growth economy, of an economy freed from regulation and restrictions, where there's more freedom of movement of people through immigration rules, is potentially upon us in the UK. To seize those days, to seize the opportunity, contact us at productpartnership.com and we'll give you help and guidance and advice. And so there's a number of ways you can make an inquiry and we'll get back to you and offer you a free review online. You can book a consultation directly to discuss your particular tax issues. And if we can't do that, solve that issue verbally, we can write and make tax returns and rebates and help you manage and administer your personal service company. I hope you found it interesting today. Don't forget to subscribe to our YouTube channel. Share it with your friends. We need to build our subscribers. We're always looking to build them, so help us share the message. Let people know what ProAct says and how ProAct can help people living and working abroad for their family and business and their property and their investments across border and down generations. Thanks very much, and we'll see you next time.